Right, good morning, everybody. It's Friday. Hope you enjoyed that music. And we're now going to talk to you a little bit about capital allowances. So today we've got myself, Paul Davison, and also one of our tax consultants, Ben Harris, who's
Good morning, everyone.
Morning, Ben, who's kindly and bravely volunteered to help out this morning. That's the wrong way. A little bit about PD tax. That's our vision, enriching lives by making tax simple. And we're really just trying to do our best for our clients within the spirit of the law, is what we're saying, and provide excellent service. That's the wrong way again. What do we do? Well, we provide tax advice to businesses, individuals, trusts, estates, etc. We also provide a tax service for accountancy firms across the country. We do the odd personal tax return form. We do share valuations of private limited shares for a number of different reasons, including tax, including discussion around legal cases. And we also do tax investigations and voluntary disclosures. So a little bit today about the housekeeping for this session. We always start at 9:30 and we finish at 10 if we can on the dots. Your mics will be disabled throughout, so you can shout whatever you want to at the screen. We can't hear you. But what you can do, though, to be interactive, is you can send us some questions via the Q&A box, and Laura will ask us those questions at the end. There's also going to be a poll in the middle, which Ben's going to run, so that will help you to get involved. And don't forget, if your question isn't answered, then we'll contact you at the end of the session for a follow-up discussion. And as ever, there's a disclaimer there. This presentation is for general information only, and if you have specific requirements, you should seek competent professional advice before taking action. Okay, right. So the first topic is super deduction, and Ben's going to talk us through that. Ben.
Good morning. Thank you, Paul, for the introduction there. Good morning, everyone. So why has this super deduction come around? Well, the Treasury has stated that since COVID-19 has struck, there's been a massive fall in business investment, with a reduction of about 11.6% from the Q3 2019 to Q4 2020. And the hope is that this super deduction will incentivize companies to invest heavily in their businesses and aid recovery following the pandemic. Other experts there are saying that it's just to soften the blow of the corporation tax rises in 2023, but I won't go too much detail into about that. So before I go into discussion about this is still draft legislation, so it's still subject to change as it goes through Parliament, but we'll go as if it is today. We don't know what it's going to be like in a couple of months' time, but we can do as it is today. So what is the super deduction? So what it is, it provides 130% first year allowance for qualifying plant and machinery expenditure, which would normally qualify for the 18% main rate writing down allowance. And as you can see on the slide, it applies to qualifying expenditure incurred from the 1st of April 2021 until the 31st of March 2023. I will discuss more of that shortly. There are some lists of qualifying plant and machinery included there, such as tractors, lorries, and vans. I won't go into too much detail about what can qualify as a plant or machinery, as I'm sure Paul will agree. We could do a whole seminar on what could be plant or machinery. But I'll skip on to the next slide. So who and what cannot qualify for the super deduction? So it is in fact only incorporated companies that pay corporation tax that will be able to qualify for the super deduction. So that means sole traders, partnerships, limited liability partnerships will be excluded from claiming the super deduction. And on top of that as well, another exclusion that will apply is that expenditure incurred on contracts entered into prior to the 3rd of March 2021 will be excluded. That's even if the expenditure is incurred after the 1st of April. If it's entered into before the 3rd of March 2021, it will be excluded. And I'll be talking about some anti-avoidance measures later, which would prevent a company, for example, cancelling the contract and then order on the same terms to be able to benefit from the super deduction. On top of this as well, the expenditure incurred must be on new qualifying assets. So, for example, used and second-hand plant and machinery will not be able to qualify for this new super deduction. And cars on top of this as well, they're dealt with under separate capital allowances, so they won't be able to qualify from this super deduction as well. One of the things that's got a lot of people hot and bothered about as well is about the expenditure on the provision for plant and machinery for leasing being excluded as well. Now, this would include, for example, property investors, landlords, propco structures who generally might not be able to qualify for this super deduction. What is important to say, though, is that the leasing exclusion is for leased plant and machinery and not directly landlords. So, for example, if a landlord does own plant and it is not technically leased, fixtures within the landlord's areas of the properties, let's say like reception areas, they potentially might be able to qualify for this expenditure. There's also additional relief for qualifying expenditure under a hire purchase agreement, but they do have to meet additional requirements to be able to qualify for the super deduction. And there's also the general exclusions that are contained within Section 46 of the Capital Allowance Act 2001. Just some other points just to raise. There's no, I think some people will be happy to know that there's no expenditure limit for the super deduction. And that's obviously going to be important for a lot of people. And there are two circumstances where the rate of the super deduction may be varied. You'll see the first one on the slide there where it says that the super deduction is time apportioned for chargeable periods that straddle the 1st of April 2023. And they do this by the time portion method by taking sort of the days that are in method A. And sorry, I think the slides went back there. Let's get back. I'm not too sure what's happening there. Yeah, there we go. So yeah, well, the super deduction is time portion. So you take the days that are before the 1st of April 2023 and by the total days in the chargeable period altogether. And then you use a special calculation to calculate the rest. Now, there's also separate circumstance where a company incurs additional VAT liability in chargeable period that ends on or after the 1st of April 2023. There are special rules that allow for this additional liability to qualify for the various super deduction, and more information can be seen in Section 236, subsection 2, CCA 2001. And on top of that as well, some people might be aware that the annual investment allowance has been extended to £1 million until the end of 2021. We don't know what's going to happen after this, but for now, until the end of 2021, the limit is still £1 million. And this will be useful to individuals that don't qualify for the super deduction. So for example, like sole traders and partnerships, they'll be able to qualify it for second-hand assets or contracts that are entered into before the 3rd of March 2021. So what actually happens when you dispose of the asset? Because I think a lot of people will be interested about this. So where the super deduction has been claimed, the disposal proceeds will be treated as a balancing charge in the chargeable period where disposal takes place and not taken to the capital allowance pools. So where there's three situations here. So where the disposal takes place in the chargeable period ending prior to the 1st of April 2023, the balancing charge itself will be calculated by taking the disposal value in accordance with the capital allowance legislation, because it's not just always the sale proceeds, and you multiply that figure by a figure of 1.3. Now, where there's a transitional period, where there's chargeable periods like accounting periods that straddle over the 1st of April 2023, you have to use a similar sort of calculation that I discussed earlier, where you take the period beforehand for the 1st of April 2023, and then the total period, and then doing a special calculation that way. Lastly, where the disposal takes place in accounting periods on or after the 1st of April 2023 or chargeable period, the balance charge is equal to the portion of the disposal value itself, Now, if only part of the disposal value is taken into account in the balance charge as well, the remaining amount will be deducted from the relevant capital allowance pool. So I think that's important to note as well. And yeah, just looking at some anti-avoidance measures as well that are in place that do allow for counteraction, which would include even a disallowance of a claim, assessment of, or a modification of assessment. And sort of the arrangements that would be caught by this include, well, the purpose, or one of the main purposes, is to obtain a tax advantage, and to conclude that the arrangements are, or include steps that are contrived, abnormal, or lacking a genuine commercial purpose, or the arrangements could be regarded as circumventing the intended limits of the capital allowance legislation. And this can include circumstances such as, let's say, a company ordered some stuff before the 3rd of March 2021. Then they decided, well, before we get delivery, we're going to cancel. This is the sort of thing that would cover it for someone cancelling the contract and then reordering on the exact same terms so they would benefit from the super deduction. Then this anti-avoidance measures would come into play. And on top of that as well, connected party transactions will also be excluded from the first year allowances as well. So this is just a brief case study. So an incorporated company would spend £3 million on qualifying expenditure, and they decide, you know what, yeah, we'll claim the super deduction in regards to this investment. So as the company spent that £3 million, it will actually be able to deduct 3.9 million in calculating its taxable profits for that year, which is then 130%, and that's where the super deduction kicks in. And then this will then provide the company with a saving of 741,000 on its corporation tax bill, which is 19% of 3.9 million. So just one final thing as well, I did fail to mention, the ICAEW tax faculty have confirmed that they have written to MPs in April 2021, highlighting about the leasing point that I mentioned earlier. So there could be some changes that could come from this, but we'll have to wait to be seen what does come from that. But yeah, thank you for letting me chat to you today about the super deduction. We'll now go to a poll, and this poll is also related to the super deduction. And so what this states is, do we think that the introduction of the super deduction will lead to companies investing extensively into qualifying expenditure, or do we think that it does not go far enough? So what I'll do is I'll start the poll, and if you could all get your fingers ready on the buzzers, we'll go ahead and launch the poll. And yeah, the poll should be on. Brilliant. That was very interesting. I would do the countdown music, but I didn't want to put you all through that. Okay, I'll give it a couple more. I think we've got 2 people left. We'll give it 10 more seconds. Might be undecided. Right, so I will end the poll. That's actually quite interesting. It's interesting. And as you can see, everyone does think that actually will lead to people investing a lot into the qualifying expenditure. So that's good to know. Right, Paul, over to you. Thank you very much for everyone having me this morning, and I'll be happy to answer any questions at the end.
Thanks, Ben. That was interesting. As I think about going forward for your clients, you can really make a difference with capital allowances when it comes to saving cash for them. Right. Okay. Just thought the slides are taking a while to update. Right, so I'm going to talk about a little bit about property, items in property and capital allowances. There's a list there of the stuff within the property that could qualify, and starting from the top going downwards, the top one is the best, the bottom one is the worst. So the first two there, chattels and fixtures, plant and machinery, should effectively qualify for the AIA under the current rules. That's 100% allowance within the £1 million threshold, or WDAs at 18%. Chattels will be like something that's movable within an office, like a desk or something like that. Fixtures, something that is part of the property, but is actually used within the trade, so like movable partitions, a crane, that type of thing. So they qualify for the AIA or 18%. Integral features, that's stuff like heating, water, also qualifies for the AI, but if it's not within that, it's a lower rate, 6% writing down allowance. Worth noting there that the super deduction should apply to these items if we have a new build that's not leased. So if you've got a trade, you've got a property, you're building a property for that trade, those items should also qualify for the super deduction. And then we've got the structure and buildings allowance, which is probably the worst allowance, and that affects the sort of the walls, the ceiling, anything of the structure itself will qualify for the 3% straight line basis, so not as good, but still worth knowing. Still, it's important. And there's also the SR annual allowance, which comes in, which is going to come in sort of same time as the super deduction. That's going to apply to things like things within the property, plant and machinery, integral features. And what you would do normally is up to 31st of December, we're still going to claim those under the AIA. But when that runs out on the 31st of December, we're probably going to look at those things like integral features, fixtures within the 50% SR annual allowance. I think that does what it says on the tin effectively. Okay. A couple of bits of sundry information. Houses don't qualify for capital allowances, although the shared areas of flats might. But fixtures and furnished holiday lets could qualify. And just another brief point of interest regarding property, land remediation relief still applies, and that is available to companies again who are cleaning up land for residential commercial purposes, and you get a 150% deduction for the decontamination costs of that land. So that's also something to bear in mind, easily not spotted. Touched on this earlier. What is a fixture? Something that is installed, although otherwise fixed into a building, has to become law part of that building. So if it's a fixture, it comes within the certain rules, and some of the key rules we'll talk about will be in relation to the buying and selling of properties, which we're going to come to next. Within that sort of definition of a fixture is our integral features. And integral features is a new item of allowance that came in 2008, which broadened the range beyond plant and machinery. So items before 2008 that weren't classified like as plant and machinery do qualify now for capital allowances, and they include things like cold water systems, lighting, electrics. So those types of things do qualify. There's a list available in the capital allowances legislation. So as I said before, capital allowances is really an area you can make a big difference for clients and businesses, and it's hard cash at the end of the day. And what we're looking really for is at the end of the tax year, when it comes down to looking at capital allowances, we can't just look at the plant and machinery additions on the fixed asset schedule there. We really need to be looking at the property additions as well, and whether that's freehold or leasehold, both can potentially qualify. Because if a client or if a business has bought a property in that year, then some of those items within that, some of that cost, the cost of a property might be £1 million, and that just sits there in property additions. But that £1 million could hide a load of items that could qualify for capital allowances. Unless we get down and analyse that cost in more detail, we're going to miss that. So we're looking to say that £1 million, how much of it qualifies for fixtures? So we get the surveyor's report, roughly 30%. So we can put that 30% through as plant and machinery or integral features. Obviously, have to break that down. Anything that's left over now, we can also claim under the structure and buildings allowances at 3%. So that's a very important part of your work when it comes to the CT return or the even the capital allowances computation. So this is a tricky area, as anybody's known. What happens if we buy or sell a property? Well, actually, the structures and buildings allowances situation is quite straightforward, because the business that first used it should have kept an allowance statement. So this is important. So I think as part of legislation, you need to keep an allowance statement if you are claiming business structures and buildings allowances. If you pass that property onto somebody else, effectively you just pass them the statement and they take over from the allowance statement where you left off. If it's partway through the year or whatever, they take over the statement. It's straight line, it's straightforward. But what's a different kettle of fish really is plant and machinery or integral features within that property being sold. So if the vendor has claimed capital allowances, or at least pooled them, i.e. put them into a pool, which just means sticking them on the tax comp, I think, then we have to look at the treatment of those capital allowances that we're moving across. And Section 198 election will be a term which people will hopefully be aware of. So Section 198 election is an election between the vendor and the buyer. It's got to be made within 2 years of the date of the transfer. If the additions qualifying expenditure is not pooled, or there's no fixed value requirement met, then the buyer can't claim capital allowances. So the Section 198 election determines the amount that's treated for capital allowances purposes only as the transfer value of those fixtures. So the buyer and the vendor negotiate and they say, right, we think we've agreed that for tax purposes, the value of items that qualify is £1. And as I said at the bottom there, the figure in the election doesn't have to make any sense in terms of being reasonable within the sort of values or the parameters. The parties can negotiate anything up to the original cost of that asset. And that figure will be binding on HMRC. That's quite an important point. So what that all means really is that, as I said before, there's hard cash here available, and allowances available to a buyer are great for them, but the more allowances that are available to a buyer, the less allowances that are available to a vendor. So it could be a balancing charge, and each case is going to be different here, and therefore it makes utter commercial sense to negotiate the Section 198 election as part of the property deal, because there's hard cash at stake. I keep saying that, but there is. The 198 election should be negotiated prior to the deal completing. If you don't do it, the deal completes and the 198 election is not made, then it could end up in the tribunal. And the tribunal might say, well, actually, our job is to work out what is a reasonable proportion of fixtures and fittings. And it could be a value which you as the vendor, or especially the vendor, possibly are not happy with. I think there's a bit of debate here as to whether who stands to gain or win more on such a debate. But I think the main point here is that it's always going to pay dividends to get your 198 election sorted prior to the deal. Or if you don't, you're the advisor, you can end up with the client saying, well, we didn't talk about this, and now I've ended up with this big balancing charge. Who's at fault here? Which we don't want those types of conversations going on. Right, so I hope you've learned something there about property, and I hope you've learned something there from Ben about the super deduction. We're now on to questions and answers. Laura, are you there? Do you have any questions for today's audience to answer?
Yes, so one of the first questions we had was asking, do the new allowances included in super deduction replace the annual investment allowance?
Sorry, does it replace? Did you say, Laura?
Yeah.
Yeah, no. So the super deduction does not replace the annual investment allowance that's in place. They do run side by side. Sometimes you'll have to make an assessment of whether which one's more beneficial to claim. But I think it's important to say that you cannot claim the annual investment allowance and the super deduction for the same expenditure. You have to claim one or the other, so you can't claim both on it. So I think that's just important. But yeah, no, they run side by side each other. One does not. Yeah, one doesn't get rid of the other.
Yeah, good question. I think it's obviously quite a complicated area at the moment, isn't it? And there's a bit of overlap going on. So yeah, good question that.
Right, and another question is where a property is sold and that property contains plant and machinery that is sold as part of that single transaction, how will capital allowances affect the base cost and or the disposal proceeds for the capital gains computation?
Shall I take that one, Ben? Do you think?
Yeah.
It sounds quite tricky, that one. Yeah, good question though. So I think it's yeah. I think luckily we had this a couple of years ago, actually, the client, and I think the key question here is the key thought process here is if you claimed capital allowances on the cost of a property, the key doubt is does that reduce the cost of the property when it comes to doing your CGT calculation? I think that's the point here, and the answer is no, it doesn't. Strangely enough, if you've claimed capital allowances on part of that cost, it doesn't affect your base cost. Your base cost is still that £1 million I talked about earlier. So you sort of a bit of a double whammy there for the client. You get the capital allowances, but you still get the full base cost. I hope that answers the person's question who asked it.
Right. I think we've got time for a couple more. So another question was, what are the additional restrictions for HP agreements?
Yeah, is that for the super deduction?
I believe so.
Sounds like
Okay.
it.
Yeah, so we're still waiting for further clarification because it does say additional requirements, but sort of a lot of the literature around it says that it will be able to qualify if they are treated as being owned by a company making the payments, if title passes when the final payment is made. So it's important to look at the contract to see what it says. And it's checking about these periodical payments and where the title is going to pass at the end. But like I said, we're still waiting for additional information from the government regarding that point.
Mm.
Right, and one more question that we had was, can super deduction be claimed to create or increase a loss, or can it only reduce a profit?
Okay, Paul, I'll take this one if that's all right.
Be my guest.
So it seems that the decision is similar to other capital allowances, that if the full deduction cannot be used by the business to set against the profits, a loss will be created, which then could be carried forward. Now, one of the important things that was announced also during the budget 2021 was the temporary 3-year loss to bring back any losses back 3 years, and that was a temporary rule announced during the budget. So waiting for more information on that, but it seems that you might be able to carry back the temporary 3-year loss, and then that potentially could trigger a tax repayment as well.
Great. Right, thanks, Ben. Well, it's coming up now to 10 o'clock. So thanks for those questions, Laura. Yeah, I hope you've all learned at least one thing today. I think the basic point is that actually capital allowances is probably, I'll say it's maligned, but it's probably it's got a lot of importance, and it's an area where unless you know your onions, you could miss out on stuff for the client. And as I said to you, I keep saying that capital allowances are hard cash, and they reduce the cost of the asset. So anyway, thanks very much. Glad you've attended, and have a great day. Thank you.
Have a great weekend, everyone. Thank you.